Congress chartered the Second Bank of the United States in 1816, 2 decades after the first bank's charter had been allowed to lapse. It was a hybrid institution, privately owned but federally chartered, holding the government's deposits and issuing banknotes that circulated nationally. Its most powerful function was discipline. When state-chartered banks issued too many paper notes, the second bank would present those notes for redemption in gold or silver, forcing smaller banks to keep their lending in check. It was not a modern central bank, but it performed one of the most critical jobs a central bank performs, acting as a check on excessive credit expansion and a stabilizer in moments of stress. Andrew Jackson despised the second bank. He saw it as a monopoly that served Eastern financiers and foreign shareholders at the expense of ordinary farmers and workers. When Congress passed a bill to recharter the bank 4 years early, Jackson vetoed it on July 10, 1832, with a message attacking the institution as unconstitutional and corrupt. The veto message became one of the defining documents of the era, turning the recharter fight into a central issue in the 1832 presidential campaign. Jackson won re-election decisively. With that political mandate, he moved to destroy the bank while it still held 4 years on its original charter. In September 1833, Jackson directed his Treasury Secretary to stop depositing federal revenues in the second bank and place them instead in a select group of state-chartered banks. Critics immediately labeled these the pet banks, and the name stuck. Overnight, dozens of state banks received a windfall of federal deposits that counted as reserves against which they could expand lending. The second bank, starved of federal funds, contracted credit. The pet banks, flush with new reserves, expanded it aggressively. According to historical banking statistics cited by the Federal Reserve History Project, the number of state-chartered banks roughly doubled from around 330 in 1830 to nearly 800 by 1836, and the volume of banknotes and loans grew even faster than the bank count. All that new credit had to go somewhere, and it poured into land. The federal government was selling vast tracts in the West, and speculators bought on borrowed money, expecting prices to keep rising. According to figures from the General Land Office cited by the Federal Reserve History Project, federal land sales jumped from roughly $5 million in 1834 to about $25 million in 1836, a fivefold increase in 2 years. Cotton planters in the South borrowed against future harvests. New towns platted only on paper sold lots to buyers who had never seen the ground. The boom followed the circular logic of all speculative manias. Prices rose because people were buying, and people kept buying because prices kept rising. Treasury Secretary Levi Woodbury issued the Specie circular on July 11, 1836, acting under Jackson's authority. The order was simple and severe. Beginning in August 1836, the federal government would accept only gold or silver coin as payment for public lands, with a narrow exception for small settler purchases. The intent was to drain speculation out of the land market by cutting off the pipeline of paper money. The immediate effect was to concentrate the country's specie in Western land offices while draining gold out of Eastern bank vaults. Banks that had expanded their loan books on the assumption that their gold reserves were secure suddenly found those reserves shrinking. Historians debate how much weight to assign the Specie circular relative to other factors, but most agree it accelerated a tightening that was already underway. Pressure was also building across the Atlantic. The Bank of England, concerned about its own shrinking gold reserves, raised its lending rate in 1836 and moved to restrict the credit extended by British merchant banks to their American counterparts. American cotton, the country's dominant export commodity, was largely financed by British credit lines. As those lines tightened, American cotton merchants found themselves unable to roll over their borrowings. Peter Temin, in his influential 1969 study, The Jacksonian Economy, argued that this British credit contraction was the more powerful cause of the 1837 crisis than Jackson's domestic policies, a view that has shaped the debate among economic historians ever since. Other historians assign more weight to the Specie circular. Both forces were real and operating at the same time. In the first months of 1837, cotton prices fell sharply in New Orleans and Liverpool as British demand softened and supply from the large 1836 crop hit the market. Cotton was the collateral behind a large share of Southern bank loans, and falling prices meant falling collateral values. Planters could not service their debts. The merchant houses that had advanced credit to planters began to fail. Historians of the period described the cotton price break as the proximate shock that converted years of accumulated financial fragility into outright crisis, though the underlying vulnerabilities had been building since the early years of the credit boom. On May 10, 1837, the banks of New York City announced they would no longer redeem their paper banknotes in gold or silver coin. The technical term was a suspension of specie payments, and it amounted to an acknowledgement that they did not have enough gold on hand to honor their obligations. Banks across the country followed within days. When banks refuse to redeem their notes, those notes become unreliable as money. Businesses freeze credit. Merchants demand coin that nobody has, and commerce seizes up. Contemporary newspaper accounts from New York described shuttered shops, empty counting houses, and unemployed workers filling the streets. May 10, 1837 is the date historians conventionally mark as the start of the panic. The suspension of specie payments was the beginning of a prolonged contraction, not a one-time shock. Banks that had expanded aggressively during the boom tried to call in loans to rebuild reserves. Borrowers who could not pay defaulted. Banks that had lent to other banks found those interbank assets worthless. Historians estimate that hundreds of state-chartered banks failed or permanently closed in the years following 1837, though precise counts vary across sources. The economy experienced two distinct downturns. A partial recovery in 1838 and 1839 was followed by a second deeper contraction after 1839 that persisted until around 1843. Some economic historians rank the combined depression among the worst the United States suffered in the 19th century, though precise output estimates for this era carry substantial uncertainty. Martin Van Buren took office on March 4, 1837, barely 2 months before the banks suspended specie payments. He had inherited Jackson's coalition and Jackson's policies, and he refused to abandon either. When businessmen and bankers urged federal intervention to rescue the banking system, Van Buren declined. His position was that the government had no constitutional authority to backstop private banks, and that the crisis was the deserved consequence of reckless speculation. He called Congress into a special session in September 1837 and proposed an entirely different solution, the independent treasury, a system in which the federal government would hold its own funds in dedicated government vaults rather than in any private bank, permanently separating the public purse from the risks of the banking system. Congress passed the Independent Treasury Act in 1840, and Whig opponents repealed it the following year after winning the presidency. Democrats restored it in 1846, and it remained the governing framework for federal finances until 1913, when the Federal Reserve System replaced it. The long political fight over the independent treasury was, at its core, a debate about whether the government owed the financial system a stabilizing hand and what the financial system owed the government in return. The Panic of 1837 and the depression that followed demonstrated what can happen when a banking system expands rapidly, the institution that enforced lending discipline is removed without a replacement, and a blunt executive order is used to try to correct the excess. When Congress debated the Federal Reserve Act in 1913, architects of the new system pointed to repeated 19th century panics as the evidence that the country needed a permanent lender of last resort. The Panic of 1837 is not merely an old story. The mechanics it exposed show up in modern financial discussions with regularity. When credit expands rapidly and concentrates in a single asset class, whether frontier land in the 1830s or residential real estate in the 2000s, the fragility is hidden until it suddenly is not. Removing or weakening the institutions that enforce lending discipline can produce effects that are delayed by years but severe when they arrive. In 1837, the people who suffered most from the bank suspensions were wage earners and small depositors who had no tools to protect themselves. That experience is part of the historical case that eventually produced federal deposit insurance, required bank reserves, and the lender of last resort function that sits at the center of the modern Federal Reserve. The institutions you may take for granted were built, one panic at a time, from failures exactly like this one.